This is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you this morning, and as always, send your questions to Brian Rezny at ReznyWealth.com. You know, I like to start off every show and talk a little bit about the economy and the investment markets. And since we are firmly into 2024, and if you've had your money positioned correctly and followed a lot of the advice we've given on our show the last three and a half months of this year, you probably would have done really well with your portfolio. I think ultimately, investors who do the right things with their money are going to be big beneficiaries of financial security. Those investors who don't follow really strict guidelines when it comes to portfolio management and research, or maybe you're sold investments you ultimately need to avoid, are going to do poorly. We see the U.S. economy doing quite well, and I've talked about that at the beginning of this year and how we're positioned in mainly large cap U.S. equity-based investments for the growth side, and then also how the majority of our bond allocation is still in floating rate type bonds for not only that financial, more that stability part, but also to making sure that we avoid the whipsaw of longer term dated bonds in any real big fashion. I think investors need to continue to avoid international investments and emerging markets. And I've had a lot of questions, of course, over the 3 months or so of this year about Bitcoin and gold, and again, areas you need to avoid. I think investors need to realize there are real money management firms out there. The only kind of firm you should ever entrust your money to is a fee-only fiduciary money management firm like Rezny Wealth Management. And in our estimation, less than 10% of firms actually manage money, are fee-only, are a fiduciary, and actively manage your money properly. There's a lot of fake advisors out there, unfortunately, and they'll tell you they're a fiduciary office, or they'll try to convince you that that annuity on the back end is really going to help your retirement. Again, make sure the advice you're getting is real advice, and make sure you get it in writing. Investments you need to avoid at all costs, and we're going to talk about that today. You know, I see a lot of carnage when we have a new client come into our office. Every month we had new clients, and they come from other so-called advisors, some of the big banks, maybe one of these so-called fiduciaries who has free steak dinners, and you were sold a bunch of annuities or other various investments that you're starting to realize 3-4 years down the road have not done well at all, even though the economy and the market's done fairly well. The number one investment to avoid are annuities in general. Annuities are just really complete garbage, and there's no reason you would ever put an annuity in your portfolio unless you're trying to pay somebody a lot of commissions and really hinder your financial security and the returns on your money. An annuity is a basic concept. All an annuity is basically a cup with investments in it. The problem is that cup has multiple cups and cups and cups. Every one of those cups that hold your investments has a cost structure. The typical cost structure of a lot of annuities that we review, 3.5%, 4.5% every single year. The two main culprits, variable annuities, and then there's equity index annuities, even far worse than variable annuities. But let me give you a lowdown. Variable annuities, the average variable annuity my firm has reviewed, and I've looked at literally thousands of annuities over the last 10 years alone, have an annual cost structure often approaching 4.5%. So imagine if your cup cost $4.50 to hold water that is essentially free. That's what a variable annuity does. So now your investments, let's say, made 8%, but if the cost of that holding vehicle, that annuity, is 4.5%, what's your real return? 3.5%. You took the risk of the markets or the investments, but because you were sold a variable annuity, convinced of all these supposed benefits, which really are kind of worthless to be brutally honest, it basically robbed your returns. The other big culprit, and even worse than variable annuities, equity index or these hybrid annuities that these advisors claim give you stock market-like returns that never will. So let me explain an equity index annuity. You basically go to a free steak dinner at a nice steakhouse. You're then convinced and scared about, oh, the market's going to collapse and you're going to lose all your money, which has never happened in U.S. history. But let's assume that one day the market goes to zero, which again, I doubt will ever happen. And if it does, the the world probably will come to an end also. But equity index annuities, they don't make stock market returns, and there's 2 reasons why they don't make stock market returns. Number 1, they don't receive the dividend of the stock market, and that's a big part of the return. Number 2, they only make a small, tiny percentage of what the price point changes year by year based upon your contract. If you're sold an equity index annuity, or you're thinking about buying one, expect to make no more than about 1% a year on average over the next 10 years annualized on that equity index annuity. If you're very conservative and you're worried about your money, the best thing you can do, go to the bank and buy a laddered CD approach. You'll probably make 2 to 3 times the return of an equity index annuity, have liquidity of your money without a horrendous surrender penalty to get all your money out. But why are they sold? Annuities are sold for one reason and one reason only. They generate huge commissions for the so-called advisor and the company or insurance company that manufactures this garbage, and it comes against your retirement security and your future well-being. Larry from Naples, Florida. How do you feel about a retirement account heavily loaded with ETFs, which are exchange-traded funds? Only a few are doing well, but the account is on the plus side. So Larry, ETFs are exchange-traded funds, and there's thousands of them. There's a lot of them we would never utilize in a portfolio just because of liquidity, the makeup, the sectors they're in, and things of that nature. If you think about this, your portfolio may have 10 different ETFs in it. And those ETFs, if designed properly, some will do a little better than others from time to time. They're not all going to go up at the same velocity. The key is, if you're taking a certain level of risk, your portfolio should make a certain rate of return. So if you're finding that you have a growth portfolio that should be mimicking stock market type returns, but you're making half of those returns, that means you've got a portfolio that's not being properly managed. You might want to find a firm that actually does real money management. But again, all your investments are not going to go up at the same velocity. One of the things I vitally stress to every investor is make sure you look at your portfolio quarterly, see how you're doing. Every quarter you're not going to be up. Some quarters you could be down, but overall, are you doing as well as you should given the risk you're taking? I'm going to take a quick break. Again, send your questions to Brian Rezny at ReznyWealth.com, and make sure you visit our website, ReznyWealth.com. Download our groundbreaking report. The 3 biggest risks you must avoid now if you care about your financial security, the advice you're receiving, and your retirement. This is a must-read report. I'll be right back. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, go to ReznyWealth.com. And if you're finding you're not happy with the management of your money or the lack of management, or you're finding that you're just not cutting it or the advisor's not cutting it and helping you move in the right direction, call my firm for a consultation. One of the things I stress to every investor, you should know how your portfolio is doing, and if you have any doubts about the ability of the firm you're with, that is a huge red flag. You need to look out for you, and you need to take care of your retirement money because you only retire once. And unfortunately, a lot of people don't do as well as they should because of some of the bad advice they receive. Steve in Fort Myers, Florida. 3M, Triple M, has lost half its value in the last 2 years. What is your opinion and why? What about the future of this company? Stephen, great question. So 3M, I would not buy it even though it's lost half its value. 3M to me is a slow growth at best company on earnings. Remember, earnings drive stock price. So if you have a stock or a company that has very low earnings growth, don't expect the stock to go up a lot. If you have a stock that has low or negative earnings growth, expect that stock to probably drop. 3M is really one of these dinosaur companies. There's no great technology that's going to drive earnings in any meaningful way. If I owned the stock, which we do not, and I would not buy this stock, I would be a seller, take your tax loss and move on to greener pastures. The biggest key to managing money is have a buy discipline from real research and have a sell discipline, again, continued research. There's times you want to shake up that portfolio. As a money management firm, there's times that we make adjustments to our portfolio because there's better places for that money. So if we own an investment and we've thoroughly researched it and it goes into the portfolio, we may own that investment for a day or 20 years or somewhere in between. But when the thesis changes for that investment, we're going to unload that investment, sell it, and we're going to go put that money in greener pastures, places we feel are going to do much better than what we're selling. Gary in Cape Coral, Florida. Thinking about buying gold just to diversify my portfolio. Is it a good move? Appears companies are making it easier for you to roll out your 401k plan. Gary, there's a lot of sales tactics out there, especially the commercials and internet ads about buy gold now. And a lot of these are around, again, selling gold to you, the consumer. If you buy gold from most of these commercials, they're actually not selling you physical gold. They're actually trying to sell you gold coins, which even have a bigger markup than companies that are selling real gold. So what I would say is, number one, as an investment, we do not own gold right now at Rezny Wealth Management, and I see no reason to own gold because there's better places for our clients' money. Gold is not a real good inflation hedge at all. It's not a safe haven, but people buy gold because A, it's gold and they think it's just magically going to go up when things go bad. Gold goes down when things go bad. Gold might go up when things are good, but if you look at the long-term returns on gold, they haven't been that great. So I would not touch gold, and I certainly would not be buying gold from a gold commercial. Again, some of these markups could be as high as 20 to 30% over spot price, which again is ridiculous. Tom in Cape Coral, Florida. What do you think about DST's Delaware Statutory Trust? Tom, great question. So a DST is not an investment. It's basically a type of an account, a trust account that you can basically purchase real estate in, usually for an IRA. So I wouldn't worry about the trust itself. What I would worry about is, what's the investment you're going to put in there, that piece of real estate? Is it a good investment? Is it going to make money? Is it going to have above average returns given the risk you're taking? So if I look at real estate in general, most people that buy individual real estate, whether it's a condo, a couple houses, whatever it is, most people do not do that well buying real estate because they think they buy it, they rent it, they make a good return, and the property goes up. Real estate values can go up and down. And the thing is, when you rent a property, if you have one bad tenant and you own a property and they don't pay you for 3 months, you just ruined all of your cash flow for the next essentially 12 months just to break even. So you have to remember, every investment you buy, whether it's stocks, bonds, real estate, gold, doesn't matter, they all have different types of risks and different limitations. So real estate is not the savior of all investments. And again, make sure you understand what you're buying before you put it in that investment. One of the investments that we highly recommend you stay away from, and again, avoid, is non-traded REITs, or real estate investment trusts. We have received literally thousands and thousands of calls on my TV and radio shows just over the last decade. People that were sold these non-traded REITs from the so-called advisor, the Wall Street firm. So there are traded REITs. A traded REIT is different than non-traded. Traded means you could buy it today, sell it tomorrow, and it could own the same types of real estate a non-traded REIT has or holds. But why do brokers or so-called advisors sell these? Because they pay huge commissions and they have huge incentives on fee cost that go back to the actually producing company. So non-traded REITs are not liquid. You may never be able to get out of these. And what people are finding is once they get in them, they can't get out. And when the property values start going down and they're losing value, again, you can't get out and basically cut the loss. So non-traded REITs really need to be avoided at all cost. The other investment that you as an investor need to avoid are investments that are considered alternative investments. These would be most likely hedge funds or commodity funds, and there's other investments similar to alternatives, but these are touted as diversifiers away from, let's say, bonds and stocks. The problem is alternative investments usually have lockups, have surrender penalties, have incredibly expensive internal cost structure that could be 2 to 4 to 5% every single year. And if you look at most hedge funds and commodity funds, they tend to be really poor performers. So again, why do brokerage firms, banks, and insurance companies create these hedge funds or alternative funds? Again, it's something to sell you, the investor. Think about this. The only 3 main investments you should ever have in your portfolio, and again, you could build and diversify a portfolio properly and have full liquidity, is stocks, bonds, and ETFs, exchange-traded funds. All the other 98%, let's say, of investment products out there, those are only manufactured for fees and commissions by the banks, the brokerage houses, Wall Street-style firms. They don't benefit you, the client. They benefit their bottom line. So again, stocks, bonds, ETFs are the only kinds of investments that ever belong in your portfolio because you could properly diversify with those 3 different vehicles within themselves, and I think you'll be a happy investor. Market Florida. How much upside do you feel is left in the market? Mark, it depends. So if you're looking at the next week, who knows? The next couple months, again, who knows? If I look at the next 3 to 5 years, the U.S. economy is doing quite well. As an investment firm, we are mainly invested in the U.S. marketplace right now and properly diversified. I don't see a lot of growth in Europe, and I certainly see a lot of problems in the emerging market economies. But if I'm looking at the next 3 to 5 years, which is what I care about, I think if you're properly invested in companies that are growing earnings and revenue, you're going to be wealthier in 3 to 5 years than you are today. As always, you need to understand that every investor needs to do the right things with their money and make sure you're always properly positioned. As an investor, make sure you go to ReznyWealth.com, download our groundbreaking report, the 3 biggest risks you must avoid now. I think a lot of investors would benefit from reading this report. If you're a retiree or pre-retiree, if you're at all concerned about your money, make sure that you go to ReznyWealth.com, download that report, learn, educate yourself on what you need to avoid for 2024 in order to protect your retirement, your portfolio, and your financial security. Dean in Naples, Florida. Our portfolio is $850K in stocks and mutual funds. My question is, we seem to have as much volatility as the market, but our returns are way less, like 3% less, based upon the S&P. From what I can tell, what our advisor says, that is normal for a dividend portfolio. What's your opinion? First off, if your portfolio is made up and is designed as a growth portfolio to mimic the market, and you have more volatility and you're making a lot less return, 30% less on average. Let's say the market average is 10, you're saying you're making 3% less than 10. That means 7. You're making 30% less returns with more volatility. What that tells me is your portfolio is not properly structured at all. And there's a lot of investors out there, unfortunately, that believe individual stocks themselves are the savior for a portfolio. If you only have a portfolio of 30 to 40 stocks, you're going to have a lot more volatility than the market. And statistically, you will underperform the market. So again, you want to have measured volatility within your goals and objectives. You want a portfolio that is properly diversified. So we like individual stocks, but when we manage a portfolio account, we often have individual stocks tempered and diversified within the ETF universe in addition. What we find is it gives our clients lesser volatility and better opportunity for total return. And I think that's vitally important. I'm going to take a quick break. Go to ReznyWealth.com, check out our website, download our groundbreaking reports, sign up for a consultation. I'll be right back after this. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. Ken in Fort Myers, Florida. We have 2 Lincoln Choice Plus variable annuities. I really don't understand the expenses, and the annuities have performed poorly the last 5 years. Our invested $250K is now worth $257. We have procrastinated coming to see you for a second opinion. Help, can I get out? You can always get out of annuities. The problem is, what's the surrender penalty to get out? But sometimes you're better to take the surrender penalty, because if you look at the expense ratio, it might only be a 1 or 2 year break even. That's something you're going to have to take a look at and decide. The only way you'll truly know what the expense ratio of those annuities are is you need to look under the hood. You need to look at the prospectus. Now, I'm not talking about your Lincoln benefit annuities in general, but variable annuities in general have very high cost structure. And it depends how many different cups you have within the cup. So again, an annuity is a cup with different investments. And a lot of annuities have another cup, another cup, another cup. So you are paying for every one of those cups that really, for most people, never are benefits you're truly going to see. But these benefits all have high expenses. That comes against your return. So think about this. If you made 8% with your investment account, and that variable annuity you have has an expense ratio of 4.5%, you're making a fraction given all that risk of what those investments are doing. Again, another reason why we do not like annuities in general, whether it's variable or equity index. They're not designed for the consumer. They're designed for the so-called advisor commissions and for huge annual fees that go to the companies that produce these products. They're just not good. One of the products you need to avoid is called a structured product. Wall Street loves structured products. And what are they? These are these complicated investments that could be tied to the stock market or the bond market or other different investments. They have lockup periods to get your money out. They make a fraction of what the markets make, and they have high expenses internally that basically come against your real return. So as I've discussed many times in the past, never ever buy investments that have lockups, surrender penalties, where your money's not liquid, and that have high expenses on an annual basis. Options are another investment you, the investor, should avoid. Again, Wall Street and bank like to sell you options. Why is that? Because options mature every month, every 3 to 6 months. They're constantly moving your money, generating more fees and commissions. And again, does the consumer benefit from options? I would say the vast majority certainly do not. Kim from Miami, Florida. What do you think about Apple? I think Apple's a great company. I do not think it's a great investment. I think at this point in time, given valuation, given the slow earnings or no earnings Apple is expected to make for this year, I would not own Apple, and I think the gravy days of Apple returns are over. Unless they come out with some spectacular new products that are really going to change the landscape. Remember, earnings growth drives stock price. Apple's earnings this year are supposed to be flat to modestly down. If that's really the case, where's the stock price going to go? Probably one of the reasons it's actually been heading north as of recent. But long term, they're already expensive. They need to catch earnings up with the cost structure of the actual stock. I don't think that's going to happen anytime in the near future. Dale from Bonita Springs, Florida. What do you think of preferred stocks for dividend income? In this current environment, given interest rates and the cycle we're in, Dale, I do not like preferred stocks. Preferred stocks are like a hybrid of common stock. They pay a higher dividend structure and usually have less growth. What I would suggest you do is look for total return. That's a strategy we utilize in our client management. So it's the growth of the asset you own, plus that dividend stream. It may be slightly less than a preferred. Added together gives you what's called total return. To me, as an investor, you will need total return growth and income growth in your portfolio for retirement. Remember, inflation's still here. It's not going away. If your portfolio is not generating enough income above inflation for long-term periods of time, you're spending down your capital and eventually you run out of money. So if you run a total return strategy, you ultimately will benefit from the growth of your portfolio, a growing retirement income, which is very positive, again, giving you more spendable income on a yearly basis. Fred from Naples, Florida. My wife and I are 67 and recently retired. Our advisor wants us to put $700K into an equity index annuity for lifetime income. How can a retired protect themselves from inflation? Will this help? Fred, this will not help inflation. Equity index annuities do not protect you from inflation. If you annuitize this annuity for life, which is what this person wants you to do, your income never goes up. If you take the average equity index annuity and you basically take the annuity option that they tell you income for life, you get the exact same payment every single year to the day you pass away. The problem is inflation is going to eat that payment up every single year by 2 or 3%. The average equity index annuity, it takes you about 20 years to get your own money back. So think about you putting $700,000 into an equity index annuity, and it's going to take you literally 20 years to get your own money back. Not a return on your money, not more retirement money. You're actually getting less spendable money based upon inflation. In fact, at a 2% inflation factor, you can do the math how fast your money is going to dwindle away, and at some point you're going to be in serious financial trouble because your income never grew from the portfolio. Byron from Fort Myers, Florida. Oil and gas stocks have not done a lot of growth. In general, I sold some of my large names about a year ago, but I still keep 2 energy ETFs, IXE and VDE. What do I think? Generally speaking, Byron, what I would say is this. We like oil and gas stocks right now. We like the big integrateds. We do own positions in these, by the way, fair disclosure. The key with any investment is there a catalyst for it to grow. We like oil and gas because the current political White House hates oil and gas. So they've got a war on fossil fuels. So with that said, oil and gas prices are up. Now, of course, we have an election coming up. There could be a new president with different policies. Remember, policy matters. So if a new president comes in and we go back to being energy independent, oil prices most likely will come down. And before that happens, we're going to be exiting our oil positions. So under the current leadership, we like oil. The next leadership, we have to see who that's ultimately going to be. But higher oil prices mean higher prices or higher earnings for big integrated oil companies, which ultimately mean great opportunity for your portfolio. Folks, I'm just about out of time. As I always stress, go to ReznyWealth.com, sign up for our instant email alerts. You can also download our groundbreaking report, the 3 biggest risks you must avoid now. Perfect for retirees and pre-retirees alike. Click on that special reports tab, instant download, and it's free. Honesty, integrity, compassion, and competence is the difference we provide in our wealth management. If you're not happy with the returns on your money, if you're not happy with the communication from your current firm you utilize, and you're realizing they're just not up to the job and they're not looking out for your best interest, call Rezny Wealth Management for a consultation or visit ReznyWealth.com and click on that consultation tab. We do manage larger portfolios. Let us help you secure your future and your family legacy.